Now it's bring in George Tsilis. Let's talk some DraftKings. George, talk to me here. DraftKings making the news. This builds on our conversation from yesterday where we talked about Bally's Corp. Bally's, of course, catching that buyout bid. This is the other end of the spectrum when it comes to gaming and the sports world. This is the new age tech, the mobile first, and very much an expansionary part of the business.
It is, and we talked about how the casino space, in at least the last 6 months, has really diverged into the more traditional casino areas away from the technology-based ones, and DraftKings is sort of the leader in that space. And today, we have a nice move to the upside. We're seeing a counter-trend rally, at the very least so far today. We'll see how the Fed announcement goes with the markets in a little bit. But DraftKings is leading today in the online sports, entertainment, and gaming complex. You have to think about the nature of their business, fantasy sports, sports betting, iGaming, and the online sportsbook business is going to be huge. And I think overall, there's attraction from analysts. You see Morgan Stanley today. They actually make a very bold statement, their analyst, on their call. They didn't adjust their price target. They got about a $31 print on the stock expectation-wise, but they've got an outperform rating from a neutral rating, basically, because of the fact that they say it's too cheap to ignore. That's actually a very bold statement overall. Now, there's a couple of catalysts when you look at DraftKings going forward. New York is looking to legalize, from a regulatory standpoint, online sports betting. That's going to be a huge catalyst for DraftKings. But overall, the stock has been down significantly, about 57% over the last year, about 45 to 50% over the last 6 months. And right now, considering the fact that the company itself is growing really significantly, last quarter, 60% year-over-year revenue growth, right now about a $9 billion market cap, and they actually have about $2.5 billion in cash on the balance sheet. So that is effectively about 5 years worth of a cash burn at about 400 million clips. So overall, maybe Morgan Stanley's seeing some opportunities, at the very least in the longer term, for companies like DraftKings, having been really decimated because they are not profitable technology names, which have been the worst performing areas of the marketplace.
So, George, I have a question about really what this analyst said, because he highlighted that he thinks this online and iGaming space is highly profitable. There's a lot of room for growth, but this feels not really like a new narrative. We've been discussing this now for really since DraftKings IPO, how this is such a high growth, high value place that will eventually grow into a behemoth. But we haven't seen that happen. I mean, DraftKings stock has been down pretty sizably over the last month, of course, with the broader market sell-off. But I'm curious your thoughts if we think maybe our expectations for this space are too high with the slowness of just the legal adoption, really state by state.
Yeah. Here's the thing, Jenny. The key word is eventually profitable. And so right now in this market, there's no appetite at all for companies that aren't profitable. And that's one of the biggest challenges that people don't necessarily understand, perhaps on the aggregate, is why are all these stocks dropping in some cases 60, 70, 80%, where DraftKings, again, is somewhere in the middle, about 57% on a 1 year basis decline in nonprofits. And that's the thing about it. They are eventually going to be profitable, hopefully, but there's no appetite for it, especially with rates rising to the upside. People want liquidity, and investors want liquidity. Companies that actually generate positive operating cash, free cash flow, and of course, earnings per share. And again, that have stable balance sheets. Now, that doesn't necessarily mean DraftKings is not a bad investment. It certainly could be. You have to consider and do your own diligence on your own. But at the end of the day, the key is eventually. Now, one of the things about DraftKings and the entire market space for online sports betting is it's becoming very concentrated. There are about 5 companies, and DraftKings is actually the leader with about 25% market share. 5 companies that basically control about 85% of the online sports and, of course, gaming industry. And this is actually huge. We're seeing industry group concentration that creates more barriers to entry, and that can certainly facilitate the movement towards profitability. And I think this is what the analyst is looking at. And also, you have to think about the nature of the business. States and local governments want taxation, and they don't necessarily have to build out a lot of infrastructure to get taxation out of online sports betting. So I think that's another catalyst we have to consider as positive. But there are competitors like Caesars, Penn National that have a combination or a hybrid of traditional casinos as well as online sports betting and gambling And those are businesses which have a balance, whereas DraftKings is very focused on technology and online, which again, in that kind of ecosystem can do very well once this market from a technology growth stock standpoint recovers. You may see end up seeing DraftKings outperform the regular casino space. But right now we have to keep in mind we have to maintain some cautious tone because of the fact that the market is still volatile relative to some of these cyclical value names versus these growth names, which again, hopefully will become profitable.
Yeah, George, a lot of really, really strong points. Certainly a little bit of appetite today for DraftKings, and it appears, at least in some of those growth rates that you talked about, that all that money they spent on daily fantasy sports advertising is maybe paying off to some extent. But George Tsilis, always a pleasure. Thanks for joining us, the Ameritrade Network contributor.